let's do a quick 1-minute recap on when I think is the best times to buy MISTI, and then let's move over to talk a little bit about selling puts. Stick around. I think you're going to like this one. Hello, my friends. This is Legend. Yesterday we talked about when was the best times to actually purchase the stock, or the best times that I look at to be the times to buy the stock. And we will slide over to the Webull chart and quickly look at that. And what we were looking at here, and this is the MISTI chart, and what we were looking about is if it was under the midpoint of that Bollinger Band, toward the bottom preferably of that Bollinger Band, those were the good times to purchase stock, in my opinion, because buying low just helps you to be able to recapture your capital quicker because you have less money invested per share. So today we're going to take a look into the option world, or the option side of things. And when I'm selling a put, preferably here on MISTI, what does that even mean? Well, when you're selling the put, you are agreeing to buy shares of a certain stock at a certain price by a certain date. So if the price of MISTI right now being at $21.23, if I was to sell a put, I'm going to pick a strike, and the strike meaning the price at which I am willing to purchase the stock at. Okay, so I would want it to be under $21.23. I don't necessarily want to say I'm willing to purchase it at $25, because I could immediately be assigned those shares, pay $25 per share for a stock that's only worth $21, right? And why would I do that? Well, I wouldn't. In my case, I would not. So I would pick a strike under the $21 range here. So we'll just throw a number out there, and we'll just say if you picked $19 strike, right now the current price is roughly $21. And if you pick a strike at $19 and you pick your date for May, say the 16th, and that May 16th, you're saying if the price of MISTI by May 16th gets at or under $19, then I am willing to purchase those shares at that price. So if the price of MISTI on expiration, and that May 16th would be the expiration date, that is the date at which the contract expires. So it will either get assigned or it will go and be sold worthless. Otherwise, it would be worth nothing because the price never got that low. So if the price was under $19, even if the price is at $15 or even $10, right? Say on the 16th at expiration date, the price is at $10. Well, my contract says I'm willing to buy those shares at $19 by this date. And if it's below that price of $19, I am willing to purchase those shares. So the current price, if the current price is $10 and my contract says I pay $19, I have to buy those shares at $19, even though they're only worth $10. Now, you say, why in the world would you do that? Well, it's just simply a game of premium. And what that is that is the amount of money that they are willing to pay you to make that contract. So when you are the seller, you earn the premium. And when you're going to buy the option or buy the contract, you're the buyer, you pay the premium. So that's the reason I like to be the seller of the premium. That way I earn it because I'm selling it, so therefore I get paid that amount. So let's just take a glance here at the option chain, and just for fun, we'll just look to see what, say, a $19 strike for May 16th would actually pay us if the market was even open. So here we are on the options chain, and here is the expiration date. And if I minimize that, you can see here's all the dates that you can go out to, and you could pick any of these dates that you would want that contract to be good for. but I like to start with, say, about a month out. That gives you plenty of time so you don't get that time decay, and it will help also to get you a pretty good premium amount. So I click the May 16th. There's our current price right now, that $21.23, and we're going to say we're going to sell a contract at $19. Here is the bid and here's the ask. Okay, so what I usually try to do is I usually try to pick a premium price between the two, somewhere in the middle. Well, that middle would happen to be 78 cents over here, because as you can see up here at the top, MID, mid. So your bid and ask is what it's being sold for and what it's being bought at. So it's being bought at 90 cents but being sold at 65 cents. So there is the spread for the option. And usually if you pick somewhere in the middle, most of the time you can usually get that price for that option. Not always, but that's what I always shoot for. I always shoot for somewhere in the mid. So for a $19 contract for May 16th, I can earn 78 cents per share. Well, a contract is made up 100 shares. So that's 78 cents times 100 shares, which is $78, times how many ever contracts you have. Well, if we only have one contract, then that's $78. And if you have 10 contracts, then you're looking at $780 to get paid that premium, right? So for a $19 contract, they will pay me $78 per contract to agree that I will buy those shares at $19. Now, if you are thinking, well, I would like to buy at a lower price, right? $18 or $19. I'd like to get it for that. So why not sell a put in the meantime? So you could set a $19 put for whatever expiration date you want. And if it did get down that low, then you will own those shares at that price. Now, if it gets down to below the $19 and say it's only April 25th and the price of MISTI goes down to $18.50. So it is below your $19 strike. Does that mean that you automatically have to buy those shares at 19? No, it does not mean that you automatically buy those shares at 19. It does mean, though, you could be assigned early. At any point that price drops below your strike price, you could be assigned early. So at any point that the actual price of the stock goes below your strike, you could be assigned early. It's only happened to me a couple times, but most of the time it will go all the way to expiration. And at that point, if it's still open and it's still below it, then yes, you will be purchasing those shares at that price, no matter what the current price of the stock is. Now, if it's above it, then you do not have to buy those shares. The contract gets void, and what that actually is, what they call it, is it expires worthless, meaning that you don't have to pay to get out of it. It's worth $0, so they're not going to exercise you on those shares because they can sell the shares for more at market price than you would be willing to buy them at. So if it's above the $19 at expiration, then the contract just dissolves and you can open a new one on Monday morning if you would like. But it just gets canceled. The brokerage firm, whoever you're working with, takes care of it and it just goes away. So it expires worthless. But if you're wanting shares of a certain stock, why not sell a put on it? Because if you're willing to buy the stock at $21.23, you could even write it closer to the money than that. If you're willing to buy it at $21.23 right now, why not do a $21 put, earn $190 for that put, and if it is below or at that price by May 16th, then you will be purchasing those shares at $21. The hard part is a lot of times is if the stock is at $18, well, now you're looking at it, Well, I don't want to buy it at 21, but you would have already anyway, right? If you bought them on Monday morning at $21, you own them at $21. Whether you own them now at $21 or you own them on May 16th at $21, they're still purchased at $21. Why not earn $1.90 and still own it at $21? The only difference is actually you can take that $1.90, subtract it off your price right there, and actually have essentially owned them at $19.10, because at $21 minus the $1.90 that you earned, you could take that off of the price. Therefore, you're going to subtract $1.90 from $21, and that'll take you down to $19.10 of what you have invested into that amount of shares. So again, I think that's a win-win, right? Especially on a stock that you want the shares for. Now, you don't have to do it out to May 16th, You can do it out for a week. And here's May 25th. You can do a $21 put. If you're wanting to buy these at Monday morning, you could sell a put at $21. That's pretty much right there at the money. Earn about $42. And by Friday, if it is at 21 or below, you'll own those shares at $21. The only difference is you earned yourself a little premium just for being patient and waiting until Friday to own those shares. Now, if it goes up or it does not get below 21, then you will not own those shares, but you can write in another put and earn another premium. Now, you can also, and we won't touch much on this, but if it does get down below your strike, you can also roll it. And to roll it means that you're willing to buy back your contract for whatever it was, and then write a new one further out in expiration and lower in price so that you get a credit for doing so. And then take the difference between the two, and a lot of times you can still earn a premium, a credit premium, by rolling it down in price and out in expiration. So I may have to do a video explanation of an example of that, but just wanted to give you the 10,000 foot view of selling the calls, selling the options, selling the puts. And selling the calls is really the same thing, you're just on the other side. But for selling a call, you have to own the 100 shares. And then you sell your call, saying you're willing to sell your shares at a certain price by a certain date. So it does the same thing. The only difference is now you own 100 shares, and you could have earned those, or you could have got those 100 shares from the put. If you were assigned the put at 19 previously, you can turn right around and you can sell a call then at $20. And if it gets above that price, they'll take your shares, but you would have earned the premium for writing that call, and you'll also get that price appreciation of $19 to $20, which is $1 per share, so you will have earned an extra $100. So again, a win-win. It really is. I love selling options, but there are, of course, risks at doing so. You could be buying a stock that if it would continue to drop, you may own it at a higher price. So therefore, you don't sell puts against a stock that you do not want to own anyway. But if you plan on purchasing shares of a certain stock, then why not write and sell that put? Earn that premium, and then if you get assigned, so be it. And if not, then sell another put. So I know that was a lot to really take in on this one, and I may look to try to see if I can't break it down a little bit more into individual pieces, but that was kind of really the overall overview. And if you sell puts, or if you sold puts before, then you're probably already a few pages ahead of us on this. But for those who have not, this really wasn't an introductory to that, but it's just a video to show you that there is a way of making a little extra money on a stock that you want to purchase anyway. So I think I'm going to wrap it up right there. If you don't mind hitting that subscribe button and smash that like button, it'd be much appreciated. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, legend out.